Have you ever wondered why some people seem to effortlessly grow their wealth while others struggle to make ends meet? For instance, Warren Buffett's Berkshire Hathaway Incorporated posted a $35.5 billion profit in the first quarter of 2023 alone, as someone struggled just to break even. What's happening? Well, the secret of Buffett and others like him lies in understanding the art and science of investing. In this video, we guide you through the basics, step by step. Step 1. Understand why you should invest. Think of your money as a seed. When you invest, you plant that seed in fertile soil, nurturing it over time until it grows into a sturdy tree, bearing the fruits of financial stability and security. Unlike traditional savings, investing offers the potential for your wealth to grow significantly over the long term. Step 2. Determine your financial goals. To do this, ask yourself some questions. Are you investing for retirement, buying a house, or funding your child's education? This way, you can determine your goals, which in turn influence your investment strategy. A long-term goal, such as saving for retirement or higher education for your children, might involve higher-risk investments with potentially higher returns. In contrast, short-term goals like building an emergency fund or saving for a vacation may require safer, more stable investments. Step 3. Learn about your risk tolerance. So, to bring you up to speed, risk tolerance is your ability and willingness to endure fluctuations in the value of your investments. Why? Because investments inherently come with risks. The value can go down as well as up. For this reason, it is best to assess your risk tolerance honestly, leveraging appropriate tools like a risk tolerance questionnaire. If the idea of losing money keeps you up at night, you might prefer more conservative investments, such as government bonds, blue-chip stocks, or index funds, which tend to be more stable. If you're comfortable with some risk for the potential of higher returns, consider more aggressive investment options like individual stocks, high-growth technology companies, or emerging market funds. Step 4. Familiarize yourself with the concept of diversification. Don't put all your eggs in one basket. You've probably heard this saying before, but in the world of investing, it's golden advice. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, and real estate, to reduce risk. This means that if one investment performs poorly, others might perform well, balancing out your overall returns. Step 5. Learn about different investments. So in this regard, we have the following. 1. Stocks. When you buy a stock, you're essentially buying a small piece of a company. Stocks have the potential for high returns, but they can also be volatile, so research and choose companies wisely. 2. Bonds. Bonds are essentially loans you give to companies or governments in exchange for periodic interest payments and the return of the bond's face value when it matures. Bonds are generally considered safer than stocks, but offer lower potential returns. 3. Mutual funds. Mutual funds pool money from multiple investors and then invest in a diversified portfolio of stocks, bonds, or other securities. They are managed by professional fund managers and are an excellent option for beginners due to their diversification. 4. Real estate. Investing in real estate involves purchasing properties to generate income through rental or capital appreciation. Real estate can provide a steady income stream and potential tax benefits. And just to add, you don't need a lump sum to get started. You can begin with a lower investment by investing in real estate investment trusts, REITs. 5. ETFs, exchange-traded funds. ETFs are similar to mutual funds, but are passively managed and traded on stock exchanges like individual stocks. They offer diversification and are often more cost-effective due to their lower fees. Step 6. Understand the concept of compounding and its power. See, one of the most magical aspects of investing is compounding. This is the snowball effect where your initial investment earns interest, and then, over time, that interest earns interest. And you know what? The earlier you start investing, the more time your money has to compound, potentially significantly increasing your wealth. Step 7. Learn about different investment strategies, such as 1. Dollar cost averaging. This is where you invest fixed amounts at intervals, buying more shares when prices are low, reducing average cost. 2. Value investing. Here, you identify undervalued stocks with strong fundamentals, expecting they will get market recognition and give you significant gains. 3. Dividend Reinvestment Plans, DRIPs. With this strategy, you reinvest dividends instead of withdrawing them to acquire additional shares, increasing your holdings without extra fees. 4. Tax-efficient investing. This strategy involves utilizing tax-advantaged accounts like IRAs or 401ks for maximum savings through tax benefits. 5. Sector-specific investing. With this method, you focus on sectors like renewable energy, technology, or healthcare based on potential growth. Now, as we wind up, remember that while following these key steps can significantly enhance your investment journey, to ensure success in investing, always keep updating your knowledge to stay abreast of the latest, most effective investment tips. Now, what are your thoughts on investing? Leave your comments below. While at it, like, share, and subscribe for more digestible and practical personal finance and money mindset videos.